So here's where we stopped. We got PC inflation. We talked about this one. It is disinflationary. So it's construction spending. And then we have the ISM manufacturing. That was a recession indicator, along with factory orders, JOLTS. And then we got the ADP that shows disinflation. ISM services, unfortunately, shows an economy heading into a recession. CPI, PPI. PPI is clearly disinflationary. Although we can argue about, it's energy and non-energy and all of that. CPI, it is on face value disinflationary. But then you talk about core CPI, you talk about core services up year on year, up month over month. Some could make the argument that the CPI was actually an inflation indicator, that we have more inflation in the pipeline. But we'll take it at face value here and say, okay, it's disinflation along with the PPI. But this week we got retail sales. And by the way, on Friday, major move in the dollar and bond yields. So what happened? Why did we see the dollar and bond yields spiking higher and upsetting the stock market? We got retail sales. That's negative. The most negative reading since last October. Now, we can have one negative reading once in a while, but that doesn't make a trend. Yet if we exclude the first month of the year, which was warmer than usual, which contributed to higher retail sales, the negative all in all has been negative since November, folks. November, December, February, March. Negative retail sales. I would view this as in the recession camp. And then we have to talk about import prices. Unbelievable. They're dropping like a rock. Now deep into negative territory. The same kind of readings we saw in the lockdown recession. So again, a lot of folks will look at this. You can pin it against the CPI, core PPI, core CPI, core PCE, average hourly earnings. And you can look at this and say, wow, import pricing is showing massive disinflation to come. So it's just a matter of time before we see the CPI, PCE, PPI all going down. The problem is, number one, what if core CPI, for example, sticks while import prices go down? Isn't this an indicator of an economy heading into stagflation with the pace of economic activities, which factory orders measure, collapsing while the core CPI is sticking higher? Number one. Number two, if you're using import prices as a leading indicator, look at how negative it is right now. And what you're actually predicting is a massive recession because, core CPI, core PPI will collapse following import prices. And that's a huge indicator of a recession. So for now, whether you look at it as stagflationary or recessionary, it doesn't matter. At the end of the day, there is an element of a recession in the reading of import prices. So we're going to categorize this as a recessionary piece of data. But perhaps the most impactful macro piece of data that we got on Friday is the University of Michigan consumer inflation expectations. Look at what happened here. The previous reading was 3.6. The forecast was 3.5, a drop month over month. Instead, we got a shocker, 4.6%. Inflation expectations are surging higher again. So sure, we see the CPI moving down due to energy prices moving down in the month of March. But we know what happened to energy prices since then. And then you got the core CPI sticking. You got retail sales dropping by a little bit. And you see the spike in inflation expectations, not only according to the University of Michigan, but also according to the New York Fed. So we know that the inflation psychology is still embedded in our economy, meaning it is absolutely delusional to declare the war against inflation over, and it's certainly more delusional to expect the Fed to cut rates right now. Not going to happen. So we're going to categorize the University of Michigan data as inflationary. You put it all together. Why did the dollar spike higher along with bond yields? And we saw a weakness in the equities market. The expectations, the odds for the May meeting, 25 basis points with 84%. It's pretty much in the bag right now. And then we have to talk about how many 25s we're about to do. We're not going to do 50 right now. The Fed is too afraid to do 50. But the market says every single time, okay, one more 25, and then we pause. We've been saying this since December, folks, and every single time the Fed raises by yet another 25 basis points because the battle against inflation is far from over. Now, David Rubenstein says that interest rates will continue to go up for a while after all of the data that we got. And mind you, Rubenstein is a board member of the New York Fed. He is on the advisory committee, and he also happens to be Jerome Powell's former boss. So when he says, rates will continue to go up for a little while, I believe him. And then you got BlackRock CEO, Larry Fink. He says the number of Federal Reserve interest rates, the increases, will be 3 from this point on. So 3 25 basis points. You know what the market is pricing right now? 1 and then 3 interest rate cuts later this year. BlackRock CEO says, no. It's going to be 3 interest rate increases. Now, we don't see cuts at all. So this is already a problem for the stock market. You know why? Because the market right now, as I said, pricing in interest rate cuts. Anything that upsets this outlook by the market, we're going to see an oversized reaction to the downside. And so far, the macro data says to the market, hey, you're way ahead of yourself right now. Number 1, the fight against inflation is not over yet, which means that the dollar and bond yields might rebound. This is not good for you, and certainly no interest rate cuts this year. Number 2, we have a lot of data pointing out for a recession. Do you really think interest rate cuts amidst a recession is good for stocks? You have the tunnel vision syndrome, looking at Fed rate cuts, but you're ignoring why they're cutting rates. But the market for now doesn't care. Look at the charts. We were supposed to go back to the October lows right now. As we speak, the only thing that rescued the stock market and initiated a continuation of the year-to-date rally is the collapse of SVB and Credit Suisse, the banking crisis, because the market looked at that as, oh, here we go, the Fed is going to cut rates. Good for us. We don't care why it's happening. All what we care about is the Fed is cutting rates. The market has been wrong about this assumption back in 07, 08, and I believe it's going to be wrong in its assumption this time around too. And most importantly, why did bank earnings upset the stock market on Friday? Remember, the macro data pretty much sealed the deal. No interest rate cuts. The market's only hope for rate cuts right now, regardless whether you think they're going to happen for the good reasons or the bad reasons, the only hope left for the stock market right now for rate cuts is more turmoil in the banking sector. Because so long as we have banks blowing up, massive fear headlines coming from banks, oh, so-and-so bank blew up, so-and-so bank stopped lending, so-and-so bank deposits are leaving en masse. All of these really bad headlines, the market looks at them and says, okay, good enough for me, because it forces the Fed to cut rates. Now, unfortunately for the stock market, bank earnings were a lot better than expectations. Let's say better than feared. Therefore, now the stock market is in a dilemma. It is looking for rate cuts. It cannot find them looking at the macro data. And now it appears it will not find them looking at bank earnings.